Good afternoon, ladies and gentlemen, and welcome to today's webinar session. My name is Olalikon Emmanuel Akinola, market analyst at HFM Nigeria. It's a pleasure to be here again this afternoon. Looking out for interesting topic today, moving average crossovers. Very, very important question and very, very important topic, majorly because of some of the things that we've been talking about, recently, especially with the HFM VTF. Over the past few days, I have been talking majorly about, we're about to see, a shift in momentum, from buyer's point of view to seller's point of view, especially when we have changes in fundamental situations. Maybe you have a situation fundamentally where you believe that a particular market is expected to move in a particular direction, but then out of nowhere, we're seeing new sets of information, and that information might be suggesting potentially a change in movement, right? Normally, we could use the distribution of information that we have, check how important they are in the long run, and determine if we're expecting to see any potential shift in momentum. Another thing that we also try to look out for is key technical structures that could also help us determine, are we about to see a shift, or whatnot in terms of long-term moves, for a particular asset in the market. But you see, today we're going to be examining one other side to which you could also determine if we're going to see a shift in momentum, or if you can pursue a particular direction over a particular period of time. And that is using the moving averages, in this particular case. I believe Heritage already recorded a video on moving averages, and I think Fibonacci sometimes 2-3 weeks ago. We have that particular video up on the Telegram channel. So today we're not going to do too much or dig too deep in terms of what do we call it, in terms of explaining what moving averages are, right? We're just going to do, a little bit introduction to moving averages. I'm going to refer you to some of the videos that we have on the HFM YouTube page, right? Specifically, we have like 3 different messages, videos on the HFM YouTube page that you could potentially look out for, in the grand scheme of things, right? And yeah, I'm just going to show you that in a few minutes. Just give me a little bit of time to work on something. And while I'm doing that, guys, please send a message in the Q&A. Let me know if you can hear me, and then you can see my screen. All right, please share share a message, share a message, share a message. Let me just confirm that yes, you can hear me, and you can absolutely see my screen. So right here, we can search moving averages. All right, I just want you to understand that we have maybe at least one video or two on moving averages. Yes, Heritage recorded this moving average on I think 2-3 weeks ago. This was 3 weeks ago. We have one from 1 year ago. So clearly we have videos clearly explaining what moving averages really have for us in the market. So today we might not just do too much, explanation of moving average, but deal exactly with what we're talking about in form of the moving averages crossovers, right? The moving averages crossovers. Are we ready? All right, so I have some messages from my friends in the Q&A confirming that they can hear me. Amza, Samuel, Ahmad, Asisam is here as well. Joshua, John, Shola, Charles, Amza. Okay, great. Winston, Joshua as well. Patricia, Chika, thank you guys. All right, thank you for confirming that you can see my screen. And we can continue with the session today. Like I said, if you need introduction to moving averages, please ensure that you watch some of these videos. They would help you at least really understand what moving averages are really all about. My own job today is to expose you to crossovers. And for me, the only reason why I would like to see a crossover is majorly to see if I can catch some, opportunities in either direction, either up and down, depending on where the market is at the time and the direction that I think the market should be going. And let me start from saying this, that no matter what, right? No matter what. And this is my own personal belief. This is not necessarily a market opinion. This is not also a textbook opinion in the sense where you say, maybe this is how the market wants it to be. This is Mr. Emmanuel's opinion right now. I believe that indicators would always work better when you put in your own input and not ask them to just do what you're supposed to do. That's my personal belief with indicators. A few days ago, someone sent me a message saying, do I have any bias against indicator, that why don't I talk about indicators? And I'm like, listen, it's not like I don't like indicators. Indicators work, right? For people who know how to use them, indicators work. I might not be the biggest fans of indicator in the market, but I can tell you for a fact that if I'm going to use indicator, it must be that I needed to contribute something to what I already know. It means that it might not work as effective as you want it to work if you don't even know anything at all. Say, for example, you want to see what the moving average have to say, about this current chart that we have on the screen. You want to see if market is trading above the moving averages or trading below the moving average, as the case may be. So you just want to have an opinion on where the market is, directional bias. So you're like, oh, they said if market is above 50 moving averages, you can look for an opportunity to buy. If it is below it, you can look for opportunity to sell, as the case may be. Maybe that's the general opinion. 50 is one of the most popular moving average that we have. So you're like, okay, I want to check. So now that the market is currently above, current price right here, like market is currently above the 50 MA, it means I'm supposed to be buying, looking for opportunities to buy. While you might not be wrong to say that, right? While you might not be totally out of the window to make such statement or feel that way, according to what you have on the screen, one thing I can tell you is this. It would even be better, guys. It would even be better if you had like something additional information about this chart. It will make it better in a sense where, for example, now price is above the 50 and maybe you have like already a bullish bias on AUD USD, for example. It makes more sense. But in a scenario where your own bias, clearly it's not the one to buy, and then you're looking at the market above the 50 MA, as the case may be, what then are you supposed to do? That's one of the questions that I want to answer in this session today. So I'm going to start way from the beginning, and I'm just going to remove this so that we can get on the same track, especially for those of us who don't have any knowledge about what moving average is all about before we even get talking about the crossover. So firstly, what is a moving average? A moving average is simply an indicator in the market that helps you smoothing out the noise away from price movements, right? Say, for example, I don't have, what's it called? This is um, a candlestick chart, right? And if you look at this in terms of price movement, there's so much noise on this particular screen. What do I mean by noise? Noise means the market is not exactly moving in one particular direction, right? In the sense where you have prices going this way, right? So you have, yes, let's start from somewhere around here. So we have a screen like this, and we want to look out for market movements, and we're like, okay, market rose here, right? And the market dropped again, and at some point went back up, but then it started ranging up and down, a little bit. My screen always moving. It's fine. I just need to anchor it with this so it stops moving, right? And then we have all of this back and forth, and then this also, and then it dropped, it went back, it dropped, it went back. So you have like a lot of movements, and eventually, okay, we now saw a clear movement to the top at some point, but no long after we saw a clear movement over, great, we saw another clear movement up to the top again, and then eventually the market started going, sideways again, very messy movement, up and down like this. This is like market noise now because the market exactly is not moving in one particular direction. So all of this, the chart looks so messy, but as a way to always view this chart in such a way that you can look out for how the market is moving, and say, oh, it was going up clearly at this point, it ranged at this point, it dropped at this point, and all of that. We can do that by visual, but moving average could also do that for you to smoothing out the movement of price, the original movement of prices in the market, filtering out all the noises that is available in between, and then you can clearly tell, okay, this is where and how the market has been moving, this is where it is right now, this is potentially where it might be looking to go. So it is something that majorly works based on precedence. If you watch the past video that I recorded, sometimes you're going to explain that moving averages is actually something that they teach you in statistics back in school. Maybe stats 201 or stat 102, I don't remember, but one of them, they'll teach you what moving averages are. They give you E and F, something like this, give you some, what's it called? Figures, right? They give you figures, plenty figures, 5, 6, 7, 8, 9, 10, and they'll say, okay, calculate the 3-day moving average or 4 days moving average, and you have to for 4, add it together divided by 3, and then you omit one space, you go to the next 3, right? And then you omit again one space, you go to the next 3, and that's how they calculate moving averages, right? Based on statistics. So you always omit one and go to the next one. So literally it is to smoothing out that particular sample size you're working with. It's smoothing it out for you. That's the main thing about moving averages. It's simply it's calculation, it's statistics. But that statistics has now been put into the system for you to be able to work with. Now you can ask the moving the chart to calculate how many days moving average you want, how many period. If you want 1, you want 2, you want 3, you want 4. And listen to this, you can put any number that you want as a moving average. That's one thing I can do also. You can literally put any number you want for moving average. If you put 1, the market will not say no. If you put 2, neither will the market say no. If you put 3, the market won't say no. If you put 10, 5, 7, the market won't reject it and say it's too small. It's too big. Listen, like I said, in statistics, you can calculate 2 moving average, 3 moving averages, 4 moving average if you want. The ball is within your court. But one thing is the likelihood to follow industry, standard. And which is why, over the time, even if you're new to trading, if you go to the net and you check anything about moving averages, some of the most common ones will be 50, will be 100, will be 200, naturally, right? You would always see, posts like that, talking about the 50 moving average, the 100 moving averages, and even the 200 moving averages in the market. So clearly, we have some popular ones. Yes, by good standard, good metrics, we have some popular ones, but I need you to also understand that they are not fixed. They're not the only ones that exist. And for a fact, let me tell you this, I'm saying this categorically, not also as a market opinion. You can find your own moving average because someone also discovered the 50, the 100, and the 200. I don't know if you get that. Someone discovered the 50, the 100, and the 200 based on, how he or she saw market reaction to it, and how well it was able to work. And then someone put that out there, and then everybody took it as, a mantra and started using it. You also can create yours. In fact, as popular as the 50, 100, 200 used to be, nowadays, we're starting to see new combinations. I promise you. Nowadays, we're starting to see new combinations that are not yet as popular as the 50, 100, but it does not invalidate them. If someone says it works, I've tried it, at least for myself as a strategy, it works for me and is able to articulate, show us some things where it has worked on. It is okay for us to also take it, not as, what's it called, the Lord and Savior, really, but something to which we can also investigate. So when it comes to period, right, guys, setting period on moving average, there is no rule to it. There is no, this is the only one you can put inside. Put anyone, see how it works, right? But you see, the way we think about it is this. When it comes to moving averages, there are slower moving averages and there are faster ones. Okay? There are slower moving averages. And there are faster ones. And what we mean by that is that there are moving averages that naturally they react quickly to prices. They react quickly to prices, they follow prices, they stay too close to prices. Those are the faster ones. They're so fast. It means that they stay very close to price. They don't stay far away from prices. No. They don't stay far away from prices. They're really close to prices. And for a moving average to be fast and to stay very close to price, it must be that it has a short period length. What that means is if you're looking to use, what's it called? A faster moving average, you're looking to use something, in the relation of, let's say, 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. I'm calling them one after the other because like I told you, all of them will work. But as long as the period is short, it means you're using a faster moving average. 10, in fact, 10, 20, all of them are still on that short moving average. They're very short. You know why they're very short? Because it means you're only adding the first 10, right? And imagine you're applying a moving average of a period 10, for example, and you're using close price. It means you want the market to work with the last 10 closing price on the particular chart you're looking for. Imagine you're on 10 minutes time frame, 30 minutes rather. So you're saying the market should look out for the last 10 price closures to create the moving average. That's very fast. It will be too close to price. It will hog price. And not like it is bad. It is actually good because it has its own functionality, right? There's something that you'll be looking out for that will require you to use a faster moving average. And it includes, for example, spotting short-term momentum shifts. Like I told you today I want to talk about majorly momentum shifts in the market, right? So this one can help with short term, not long term, which means if you're more or less like a day trader, someone who trades within the day, or you're more or less like, a scalper, someone is just looking for price changes, you might appreciate, the faster moving averages for short term, price shift or momentum shift in prices in the market. And also one of the major things it can do is that it can also help with, entry and exit triggers. You see, if we're going to use moving averages for entries in the market, naturally, at least for me, and I know for at least for HFM, we have a way of combining two moving averages together where we use one for confirmation and we use one for entry. And I can tell you for a fact, the entry strategy or the entry moving average is always slow. Sorry, it's always fast. It's always a tiny number. We prefer 9. In fact, we used to always use the 9 EMA as our own entry moving average for, short-term trading in the market. So naturally, if we're looking to use, the moving average for short-term trades, like in and out, and you're looking for something that can help with, good entry and exit triggers in the market, you definitely need a faster moving average, which means something with a short period length. A slow moving average will have, at least relatively longer period length, right? So this one will have a long period length. And that means like the 50, the 100s. In fact, I would say 50, 51, 52, 53. Because if I say 50, 100, it means I'm saying there's nothing in between. There's something in between. There's 60, there's 70, there's 80. They're just not popular. The market does not care, right? But then the market cares more about 50, 100, 200, those are what we call, slower moving average because the period is far, like 50 period, 100 period. That's a lot. You get what I'm saying? So naturally, 50, 100, 200s, usually they are slower moving averages. They react slowly to price changes. It completely removes the noise from the market for you, which means all of those shabby movements, you won't find the moving averages around them if you're using a slower moving average. And listen to this. If you were going to use a slower moving average, this is why you must understand. So you cannot just use random things. And this is my problem with moving averages, right? A lot of people who use moving averages use this randomly on any type of time frame, on any type of asset. They don't even care. They just pull up a moving average. It's not supposed to be like that. You should be able to understand which one to deploy at any point in time, depending on what you're looking for as a result from that particular time frame or particular asset, right? And this one majorly is naturally good for overall trend. This one is not short term. You're looking for overall trend, of a particular asset, and naturally, or you're looking to confirm your bias. Like, so it is good for overall trend biases in the market, and it is also a great, or not, I don't want to say great, good for spotting key support and resistance levels as well, because it could act as one. Because it could act as one. Because it could act as one. So now, it means there's clearly a difference between this guy and this guy. So like I said, longer period lengths would be like, 50, like 100, like 200, right? And this is what they're naturally great for. And for the faster ones, this one is like 9, 10, 20, like all those small ones. Right? Yeah, great. Now, this is just still purely introductory, guys. We're just coming up. So we have slower ones, we have faster ones. They don't do the same. One is good for short-term things. You're not looking to do too much one way or the other. But then the slower ones, looking out for overall trend, price changes, momentum shift in form of fundamentals and all of that, right? So if you're trying to separate them now into two, it means as someone who is looking to get short-term entries, anything short-term, that means you need a faster moving average. Naturally. But if you're looking for directional shifts, overall trend biases, then you need a slower moving average. It means now that we can create a clear disparity now and say short-term movement or short-term analysis, right? This could work, right? And if you're looking for anything from medium to long term, this would absolutely work for you. So if you're a scalper, this you most likely need a faster moving average. If you're someone who is a day trader looking for small movements in between the day, you most likely like to see, also short-term moving averages as well. But if you're someone who is like an intraday trader in the market, you're hoping to keep a position for like a day, 2 days at most, looking out for big movements in prices, or even swing trader, you might need to see, a slower moving average as well. Now, what happens when a slower moving average crosses, sorry, Well, what happens when a faster moving average crosses a lower moving average? It is what we call crossovers. Let's just do it on this side before we now deal with the chart and forget to write anything again. This is what we call crossovers. Crossovers. Now, crossovers is the movement of a faster moving average past MA going above slash below a slow MA. When a faster or a fast moving average goes above or below a slow one, that is what we call a crossover, right? A crossover is simply the movement of a faster moving average above or below a slower one. Now, the interesting thing will be when it goes either above or below, what does he say to us? Now, listen to this. If a fast one goes above a slow one, we call that one a golden cross. And a golden cross is more or less like a bullish signal. It's more or less like saying it's time for you to look for opportunity to buy. That is now, the trend is now in favor of buyers. And also, this is a momentum shift in favor of buyers. This is a momentum shift in favor of buyers. And then we also have a death cross. Now, for death cross, it is if it's a fast moving average, moving MA, if a fast moving MA goes below a slow one, then in this case, it is called a death cross. Death cross, which is more or less like a bearish signal. And this is a momentum shift in favor of sellers. Now, remember back then in school, there's one popular thing that people used to say, and it is in the class, they will teach you A plus B, and in the exam, they will come and give you X minus Y equals to K25, right? X minus Y equals to K25. Now, because here I said faster moving averages are like 9, 10, 20, and the slower ones are like 50, 100, 200. But I hope you know that even within the slower moving averages, there are still some that are faster. For example, between 50 and 200, there is a fast one. If I put 50 moving average here, for example, and I put 200 on this side, one way or the other, they might both be classified as a slower moving average, but 50 is still faster compared to 200, which means one way or the other, you can still call 50 a fast one compared to 200 being a slower one. Do you get what I'm saying? So you must understand that even between 50 and 100, 50 is still faster than 100. 100 is slower compared to 50. The more the period, the slower the moving average gets. So 200 is very slow. 50 is faster compared to where 200 is. Because now I'm going to explain to you, or just give this to you so they can have it, some form of crossovers that you must understand. And we have, the short-term crossovers, and we also have the long-term crossovers, right? When two moving averages are paired together on the same, asset in the market. And here are some of them. Please take this down. I'm going to write it down as well. Okay. So naturally, we tend to pair 50 and 200, right? That's one of the major pairing that we also have in the Forex market. We also pair 50 and 100, by the way. But 50, 100 is very, very popular, right? And this is an industry standard, right? It's popular, not like it's the only one. You can also do 50 and 100, right? Yeah, but it is very popular, very popular. And you could also do 20 and 50. And this one is very nice for intermediate swings. If you're looking for intermediate swings in the market, nothing too long term, maybe something within view, you can pair the 20 and the 50 to look out for crossovers, in the market, right? And then you can also do 10 and 50. Apparently, this one is for scalpers, majorly for scalpers. All right. So majorly scalpers might like to see the 100 and the 50, sorry, the 10 and the 50 potentially, as an option, right? But in terms of just short-term crossover, there is the 9 EMA. These ones are MAs, SMAs. These are SMAs. This is also SMA. SMA is simple. This is also simple. This is also simple. Simple. Right? And then there is the 9 EMA crossing the 21 EMA as well. If you're looking for this one, like I said, is popular for, it's very quick and fast. So it is majorly short term standard. Like if you're looking for something short term, not long term crossover movement in the market, this is short term standard across even just Forex and cryptos. It's not limited in that particular direction. All right. It's not limited in that particular direction. So yes, this four for now is what I have for you. Okay, 50 and 200 works, 20 and 50 works, 10 and 50 also works, 9 and 21 EMA also works, but they don't do the same thing, right? These two are short term. These two below are short term. The two above are a little bit medium to long term. So we can separate it by short term, long term also in that particular direction as well. So now from the top, when it comes to moving averages is simply a tool that helps us to, filter out the noise from the market in terms of helping us see clearly market movement over a period of time. But then traders, to a certain extent, have been able to harm it to do beyond that. Now it can help us, directional biases, help us to know, changes in market direction or changes in market momentum from buyers to sellers, and something that we could also potentially use for entry and exit strategy in the market. When it comes to moving averages, any period works for me and for you, but we have some industry standards, right? So one of the major things is some people already have discovered some of them that works, majorly, and we can also take advantage of that. And when it comes to moving averages, we have the slower ones, we have the faster ones. The slower ones are of longer period lengths. The 50s, the 100s, the 200s are of, really longer periods in the market, and naturally they are good for overall trend or biases in the market, and they can also provide strong levels of support and resistance. Good and very strong levels of support and resistance can be found on the slower moving averages, but we also have the faster moving averages, that are short term, that are necessary for entry and exit triggers in the market, which means you can also combine together. You can combine 50 and maybe with 9, you can combine 110. You could do any combination, one for checking the trend, the other one for entry. So you get what I'm saying? Because the faster ones are majorly for entry and exit triggers. The slower ones are for confirmation of trend. So it means you can use one to confirm trend and add faster one for an entry strategy. You can do and undo. That is the purpose of this teaching. All right. And then also, when we talk about crossovers are when, a slower moving average trades or closes above, a faster one closing above a slower one, right, in the market. And that particular move above or below is termed either a golden cross or a death cross. It is a golden cross when a faster one goes above a slower one. That's a golden cross, and that's good. That's a bullish trend signal, and also signaling a momentum change in favor of buyers. And if we see a faster one going below a slower one, naturally, we believe that to be a dead cross. And in that sense, it might signal, a bearish trend, and also potentially a change in momentum in favor of sellers. All right. And when it comes to what's it called? Crossovers, you can use 50 and 200. You could also use 100 and 200. Let me also say that. You can also use 50 and 100. All right. The industry standard does not mean other ones don't work. It's just information available on the net. But I know of other people who use 50, 100, who use 100 and 200, who use 50 and 200. So please, there's no restriction to how you want it. You can use 50, 100. You can use 50, 200, or you could also use 100, 200. So please, there's no strong restriction against that. And you can also do 20, 20, 50 as well if you're looking for intermediate swing, something short term, nothing too serious as well. And also, if you're working short term, maybe small time frames, you could also look out for 9 EMA and the 21 EMA, and also potentially the 10 SMA and the 20 SMA. Sorry, 10 and 50 SMA. So yes, that's a roundoff of everything that we've talked about. Now let's do something more chart related. Now I don't have to over-explain anything again. You can just take a screenshot or keep your notes, because I'm going to clean this off now and focus majorly now on my charts. All right. So this is a 30 minutes time frame. And majorly, 30 minutes is not too big of a time frame, which means it's a short-term time frame. And right here is your time frames for those who don't know. You have M1, M5, M15, M30, H1, H4, D1, W1, all of that as well in the market, right? So you can also check your own system on your phones. You also have your own time frames, and the time frames are divided into long time frames and short time frames. It goes without saying, right? It goes without saying that when you're talking about short ones, naturally, I would tell you that anything from M1 to M30 is classified as short-term time frame for me. Short-term. Anything M1, M5, M15, M30, I classify them as short-term. Short-term. But anything from day one down to MN, I classify them as long-term. Long-term. So if you say M1, M5, M15, M30, I say, okay, short-term. Those are short-term time frames. If you say D1, W1, MN, I say, oh, okay. Those are majorly long-term time frames. But then H1, H4 for me are somewhere in the middle. Medium term for me. Medium term. H1, H4 for me are some of the most popular time frames available. Why? Because the view is coherent enough to make some solid decisions. It is borderline interesting. I like M30 for anything short-term trading, but in terms of looking out for maybe stronger levels of support and resistance, I might want to see H1, M4 and see what levels are available on there. But still, H1 is still classified according to the internet as a short-term time frame, but I'm not really holding that 1 hour time frame to short-term like that. Honestly, I'm holding it to his own standard, somewhere in between, the bridge between the short-term and the long-term. That's for me. And I will classify it majorly as a medium-term time frame, actually. I'll classify the H1 and the H4 majorly as a medium-term time frame. Now, listen to this. If a time frame is short, if a time frame is short, it means candles form quickly and with so much noise. And in this kind of environment, right? And then you have the long ones, the long term. Here, it means candles form slowly and will lead to unknown noise. So clearly, long-term time frames, because it's slow, one day, imagine day one, it means a single candle will form for 24 hours. All the noise would have disappeared inside. You get? Now, remember we've just talked about faster moving averages and slower ones. It means slower moving averages will be better here. Right? And then the faster ones will be better here. Which means it does not make too much sense to be using 100 moving average, for example, on 1 minute time frame. Like, not like you cannot use it. There's nobody that will stop you, but it does not make too much sense. Okay? It does not make too much sense. So you want to ensure that you're conscious of the time frame you're working on and the type of moving average that you're looking to use. And you see, the 50 is kind of universal. So which means 50 can be used on the lower ones. It could also be used on the higher ones because it's more or less like the most popular moving average available. But it would naturally work better on H1, H4 being medium, right? Because it's medium. It's just like in the middle like that, 50. So it will most likely work better H1, H4 compared to bringing it to M1, M5. Yes, you can bring it there, but it's not logical, right? That's one thing I need to understand. That if you check net now and you ask the internet and you say, internet, can I use 50 moving average on 1 hour, 1 minute time frame? It will tell you yes, because the time frame will not reject it. But is it logical? That logicality is what you must answer. It is not logical. It is not logical. But yes, I'm on 30 minutes time frame. I want to see if there is anything available medium term on this that I could potentially, look out for peradventure. Have we seen a shift in market momentum from this downside? Are we looking at, a particular movement back to the top? Remember that one of the major crossovers we talked about is, the bullish crossover, which is when a faster one goes above a slower one. And we said for short-term time frame, you might want to consider the 10 and the 20, right? Or the 9 EMA and the 21 EMA. So we can look out for that first and see if there's any crossover first, right? On this particular time frame, for any reason. Have we seen any changes in market momentum? So I could pull up firstly the 20. Yeah, I'm going to use black for this. And pull up a faster one, which is the 10. In this case, we talked about 10 and 20, right? It was one of the ones that I mentioned for you. And you're going to change this to 10. I'm going to change this to, let's say, bright color. Let's say red. Right, and press OK. Have we seen any crossovers? Well, let me explain what crossovers are really all about. Look here. We had a crossover here, here. We had a crossover here. And what kind of crossover was this? This was a death cross. Why? Because the first one, which is the 10 SMA, moved or crossed below the 20 SMA. And what we saw happen after this point was a consistent movement of prices lower in the market. Like after this, after the slower one, the faster one, the 10 moved below the 20, we saw price continue to go down, right? That was a death cross there. The small number going below the big number. Death cross, because it was below. If it was above, it would have been golden cross, right? So now it worked here, one. How come? What is this? Here. What was this? Golden cross, isn't it? Because the 10 SMA crossed above the 20 SMA. But the first one worked. Why is it looking like the second one did not work? Because if you look at it, eventually the market ranged out, right? The market ranged out. The market kept going up and down, up and down, up and down, up until the beginning of the day where market now eventually started going back to the top, right? So the question is, so why did you work here, right? It worked so well here, following this death cross, and then this cross here, I'm not seeing anything too much. Do you know the answer to that? I gave you the answer to that in the beginning of this session today. The human factor. The what? The human factor. The human factor enough for you to know when to answer a signal and when not to answer a signal. The human factor is the one in play here. And what is the human factor in play here? If you check the date, this was yesterday, 14th of August, right? Yesterday, 14th of August, what happened? In the beginning of the day, we saw the market retracing the dollar ahead of the PPI release. I remember because we were on the VTF and we were saying it's going to be majorly retracement. But then unfortunately, PPI came out the highest it has been in almost 7 months, because the last few releases of the PPI were even minus 0.1, minus 0.1, minus 0.1, and then everything. And then this particular month, we were expecting it to even be 0.2%. Say we even expected a change away from the minus territory to 0.2, we got 0.9, and clearly that strengthened the dollar. So this worked majorly because there was a supporting factor, the human side. The human side. There was a supporting factor and price responded accordingly. Great. So why is this not working here? Because it is now night. Check the time. Check. This is 9 p.m. 9 p.m. Cyprus time, because our system is in Cyprus time. In Nigerian time is 7 p.m. because we're 2 hours back from Cyprus. It means by 7, you don't expect that the market is still falling lower. We all know that at any point in time, once it is 6, you expect the market to start packing up. At most 7, the market should be gone. So then you now saw a crossover by 7, and you felt, yes, Mr. Emmanuel says, when I see a crossover like this, it's bullish crossover, I should go and buy. And then you forgot that the human factor is still important, which is returning you back to where I started this session from. We don't use indicators as if they are the ones in control. We use them as we are in control, but they can offer insights. It's only offering insights to you. You're not supposed to see it as your Lord and Savior. So you see a bullish crossover, at 7 p.m. and you're like, great, I'm just going to buy it and see how the market goes in my favor. And the market says, nope, I'm just going to range. I'm going to range out because it's already end of the day. Please, I'm not teaching you who can sinker. Not the one where you've written all the crossovers down, and then once you see it like this, you just jump in. You won't think about any other thing. That's not possible. That is the worst way to trade indicators. The worst ways to trade indicators is to trade them like they can walk on their own perfectly. The best way to trade it is to not forget the human factor. You must add your side. All right? You must add your side. Now, take, for example, look at today now. Look at today, because this is where the market is today. Yes, we saw a crossover here, the small going above the 10 going above the 20, somewhere around here, right? And then we saw market actually respond a little bit. Well, back around here, I cannot say that there's a crossover yet, which means the market has not chosen a side yet per se. Here, if you look at this, it looks like they're just together. Like, it feels like right now, they're just moving in tandem, right? They're flat together. Although it's looking like the red is going to cross above the black again, but right now, it feels like they're in tandem. The question is, if the red is going to close above the black again, suggesting another bullish signal, because there was a bullish signal here, but it was late night. There was another bullish signal here, worked fine. Now the red is looking to close above the black again. Well, that's another bullish signal. The question is, where is the human factor? What is happening today? Are you bullish AUD USD today? Does the market have a reason to buy AUD against dollar today? If no, no entry. If yes, the question is go in, because it looks like this is going to happen. But then today we know that very soon we're going to receive, what's it called? Data. Retail sales will be out in a few minutes. And even consumer sentiment for the dollar will be out in a few minutes. What that means is that movement in tandem could shift in any direction when data impacts the market. That's what it means. That tandem means the rate can still go down or go up depending on what happens in the next few minutes. Because I think data should be out in maybe by 1:30. Most US data now has been 1:30 p.m. So we're not just going to swallow this thing who can sinker. without adding the human factor. Are you with me? Yes, confirmed. Retail sales is 130. So it means right now trying to just enter this because looks like it will close above. You are just deceiving yourself. You've not added your human factor yet. So let's now say you're no longer worried about short term. You now want to see more or less like a medium term movement on maybe you're preparing for next week. It is Friday. You're preparing for a new week. So you want to do your own fundamental outlook. What then do? You now forget that you put 10 and 20. You now went to H4. Do you think the chart will remove the moving averages from there? No. If you go to D1, do you think it will remove it? No. If you go to W1, do you think it will remove it? No. But does it make sense to use 10 and 20 on daily time frame? No. That is the logical part I'm talking about, which means you must be aware of your environment. The moment you switch a time frame, you must also switch your screen. And by the way, you don't need to stress yourself. You can save this. I can save this and call it 1020 SMA short term, right? Then remove it, delete, delete, or I could just edit it if I wanted to. I could do either one, and then add the one that works for higher time frames, right? You know, this is weekly now. I rather use 100 and 200 for weekly because it's very high. Rather, I don't want to do something this high. Let me do H4 and do 50 and 100 or 50 and 200, whichever one works. 50, red, and insert. Let's start with industry standard, black. And look at the 50. It has been a straight line for as long as I can remember. But guess what? It has been a good servant of price action. Support here, you know, resistance here, also resistance all around this point, right? Right? One way it's been, sorry, this is 200, right? 200 rather, the slow one. It's been a good servant of price action. Look at this move here. Let me also add 100. Let me add 100 and see the dynamics of 50 and 100. Let me add 100. 100. Let's put, we've used black to red, black and red. Let's use a blue for this. Let's make it slightly thicker so that it does not disturb those other ones. Great. And you can clearly see that both this is 100, this is 200, this is 50. Like, so just remember, 100 is blue, the slower one here is 50, which is red, and the black is the slowest rather, the slowest, which is 200, right? Now look at where you are. Look at the current market price. The current market price is showing potentially a crossover above 100. 50 is crossing above 100. 4 hours time frame. 50 is crossing above 100. Under normal circumstances, that is also more or less like a bullish signal. That's a bullish signal. But you are also not exempted from the human point of view. And the human point of view is, are you free from data? No, data is going to be out in 22 minutes because it's 108. Two, There's a level of resistance just in front of you, which means even though there is more or less like, what you have here, right, being a golden cross in front of the 50 going above the 100, the question is, are you free from every other thing you need to consider as a human being? You're not free from that. There's still this, right? This still came in. This goes. This is still here. You've not gone far. Which means you cannot see this and then close your eyes to every other factor and just say, yes, 50 has crossed 100. I'm going to buy. No, there's a problem. There's a resistance there. One, two, there's a data to be out in 20 minutes. Anything can still happen. And also, I remember I said the choice of asset is also important. AUD USD might not be the best to use strategies on in the market. You know why? Because no matter what, for those who know about assets, you know that AUD USD is not the best to use major strategies on because over time, you know it has been ranging, which is why I'm referring you again to the beginning when I said that it is not just about any kind of moving average. It is about knowing when to use it in terms of the time frame, slower ones, higher ones, also short term, long term. Also, the type of assets to use it on, which means if you cannot even provide the basic human factor, you don't even know how AUD/USD moves. You don't know how messy the chart is. You just open up the chart and put it and say, I want it to work. No, you must deploy it on charts that you know needs it, charts that are, volatile enough to pick sides, to pick directions. AUD/USD, I know, is the worst to use a moving average strategy on. Why? Because it's been ranging over days, months. Literally since May, it's been scratchy, it's been up and down. This is what noise is. So you don't expect it to be perfect. It is the reason why you can see, look at this here. It is the reason why you can see that we had more or less like a dead cross here, the 50 and the 100, and then the 50 and the 200 also. So crazy dead cross. But look at the point where the dead cross came. See, right? Even see this one. The reason why it's like this is because the asset itself, AUD/USD is a scratchy asset. You must have known that it's not going to this one, the AUD/USD. AUD/USD that is always going up and down. All the days of his life is up and down. It means in this case, you have to then bring in the human factor. So now, if human factor is coming in, what are the type of asset that I need to use this on? Euro USD, pounds USD, USD JPY, volatile asset, pounds JPY, Euro JPY, assets that moves. Go. BTC. Why? Because they move and they have stories backing them. You see, one of the major reasons why I love topics like this is because it allows me break the highs that a lot of trainers, other market analysts, traders have putting out there, where the human factor has been completely eroded. You've seen it. I purposely chose AUD/USD as an example. I'm going to pick a different asset now, and then we check. And look at this here. Look at this here. Look at the crossover here. The 50 going above the 100. Bullish crossover. Although it didn't start immediately, but do you know how long market bought after this particular crossover? Let me show you. Market bought since like 23rd of May, and market kept buying till till because we didn't have any other crossover. The market kept buying up until maybe July when momentum shifted. Momentum shifted a little bit where we saw another dead cross somewhere around there. Price dropped a little bit. Not long after, we saw bullish movement again. But all of these were fundamentally backed. And look at this crossover here. This was a dead cross right here. This was 30th of July towards the 1st of August, right? We saw this big move here, lower. And then not long after, we saw the dead cross and price continued to trickle lower. Also fundamentally backed, by the way. And you can look out for that. Now you've seen, what do you see here? A golden cross. Now the 50 has gone above the 200, above the 100, which means we might likely see an extended period of buying on Euro USD. But listen to this. Listen to this. The golden cross is not the entry point. You're not getting me. The golden cross, the dead cross, is not the entry point. It does not mean that the moment you see a golden cross or a dead cross, you just press buy, press it. No. Remember that when we wrote something about the slower moving averages, we didn't put entry or exit triggers there. Entry and exit triggers were given to the slower ones, sorry, the faster ones. It means even if you confirm golden cross, dead cross for momentum shifts in favor of buyers and sellers, you still need other knowledge of entry to enter the direction. They are only helping you with overall directional bias. Remember, I said they usher in bullish signals or momentum shifts, not entry points. That's your job. It means now that I think the market is probably bullish on Euro USD, right? I can drop my time frame to maybe M30, change away from this long-term moving average is 50 and 100, and return it back to 10 and 20. Because now I've changed time frame. I have finished using 50 and 100. There is a golden cross, back to the top, market in favor of buyers. Now I'm coming lower with a lower moving average to see if there's anything that I can use as an entry signal. Can you see that distribution, guys? And look at that. We also saw a very, very interesting golden cross, the 10 going above the 20. And look at the sweet transition of markets to the top. May I never be the one to teach robot trading. Anything that will make me be an advocate of robot trading, I'd rather stop being a market analyst. If I'm going to come up at any point in time and say, just use it like that, just enter, don't worry, I'd rather stop. If you cannot put the human factor, they won't work as much as you want them to work. If you cannot do transitions like that, where you use this, apply it here, see what you need to see, and then you move away from there and you go slower to a lower time frame and you deploy another set. That's the only way to get the best out of this thing. That's the only way. That's the only way to get the best out of this thing. The human factor must be there. The logicality must be there. The ability to switch must be there. And you can't do all of this without understanding the concept of moving average, which is why I spent the first 30 minutes explaining to you moving average, faster, slower, this there, this one, what is good for, what is that for, crossovers and this. That's the idea. You can save multiple templates. So it will be easier for you to shift. You can easily change the template to 50 and 100 on a higher time frame. When you go to a lower one, you can easily shift it back to 10 and 20. You can do it, although that's only available on the system for now. You can't do that on the phone. You can't save templates on the phone. But that's the idea, guys. The moment PPI came yesterday, we saw a dead cross here. The 50 went below the 100 here. The 10 went below the 20 here. And price continued to go down. Now that the market is also similarly trading against the dollar today, we've seen a golden cross back to the top. I'm way past my 1 hour mark because the webinar is supposed to be 1 hour. So you do 118. We have to close the session here today, guys. All right, but this particular video will be available on YouTube because it's one that you want to rewatch and you have to learn. Okay, guys, thank you for tuning in for the session today. It is always important for us to come around like this, get perspective, ideas, that would change us from just having this robotic way of trading and believing that these things can work on their own without your own inputs. This is important. I believe that this must have shifted your view on some of these things. And it works for majorly all indicators or even all tools. Most of them just apply the human factor, they will be better. All right. We've gone way beyond my time already. Thank you, ladies and gentlemen. Thank you guys for joining us again in the session today. All right, please you can send messages to me, maybe personally, just in case to take a question. Okay. Thank you, Charles. Thank you, Anthony. Thank you, Chika. Uh, thank you, Muhyiddin. Muhyiddin says I always enjoy your sugar coated tongue. Thank you. Oh, good to say so. Our YouTube channel it is HFM Nigeria. It is HFM Nigeria. Thank you, Winston. Yes, Desmond to be available on YouTube always. All right. All right, Anthony. Okay. All right. Please send me a message, Anthony. Okay. Please send me a message on Telegram, please. Let me just type my number on Telegram to you so you can send me a message either Telegram or WhatsApp. Thank you, Robert. Thank you, Ojewale. Thank you, Desmond. Thank you, Abiola. Pius, Kenny. Thank you, guys. We'll see you later. See you on the VTF on Monday. Please enjoy the rest of your afternoon and bye for now.